The UK strike, FOMC shocker, tech layoffs, and tech earning misses, all on today's episode of Weekend Windup. As a reminder, feel free to slam me with comments regarding any of the content covered in this video, and of course, leave a like and don't forget to subscribe. I'm your host, Mark Ross. Let's get started. This week has seen civil servants, teachers, train drivers, university staff, and bus drivers striking in the UK. Workers within these professions have voted in their unions to strike as they are unhappy with pay and conditions. These strikes have affected people traveling to work, university students, and grade school students. It is estimated that of the 23,000 schools in the UK, 85% have been partially or fully closed. These are not the only professions who have strikes planned. Nurses, ambulances, and physios are also striking next week. Many healthcare professionals believe that after being on the front lines during the COVID pandemic, they have not received fair financial compensation. This comes after inflation has soared over 10% in the UK, and wages are failing to keep up with rising costs. In the public sector, annual wage growth has only amounted to 3.3%. There have been reports of nurses using food banks, which is where the food is donated, and the Ukraine war has affected energy costs during this current winter period. If the Conservative government does not address the issue soon, they could see their approval ratings fall below the current 30% mark for the 2024 general election, allowing Labour to take power for the first time in 14 years. The federal funds rate was increased at the recent FOMC meeting with a range of 4.5% to 4.75% and set at 4.65% to be exact. The overall goals of the Federal Reserve are conventional, with a targeted inflation rate of 2% and hopes of achieving maximum employment. Indicators used in their dovish approach, or cumulative tightening of their monetary policy, were the growths in government spending, overall production, a stable job market, and the easing of inflation, despite the acknowledgement of some uncertainty present. While COVID may no longer remain a predominant factor weighing on the U.S. economy, the Federal Reserve has stated the presence of negatives still remain. In addition to employment gains, their ongoing increases allows our economy's money supply to gradually tighten and ease pressure on economies currently undertaking sustainable development, such as Japan. In anticipating the recent FOMC meeting, the Dow Jones Industrial Average tumbled more than 300 points, while the Federal Reserve promised to end rate hikes soon. Overall, equities fell as well, while Meta was up nearly 3%, as investors anticipated the reports of their earnings for Facebook and Instagram. During the press conference, the stock market began to rebound as the disinflationary process began. The Dow Jones rose nearly 10 points and remained relatively unchanged. The Nasdaq Composite gained 2% as a central bank pivot known as the turning point was observed, with a positive outlook described as a half-full glass. A huge shout out to all of you for partaking in this. It's amazing. It's only the 4th episode and already we're able to afford our very own corporate sponsor. Without further ado, Mark? Thank you, Mark. You are too kind. All right, if you are interested in finance, buy this book on Amazon, Mark's Guide to Sales and Trading. It will be the best investment you will ever make in your life. Back to you, Mark. After a period of what some would call unprecedented prosperity, the once high-flying technology sector has seen a massive wave of layoffs that has resulted in thousands of employees across departments to lose their jobs. Tech behemoths such as Alphabet, Amazon, IBM, and Meta all laid off thousands of workers in response to economic slowdown, or because Elon Musk did it, rising interest rates, and an overall theme of consolidation in the technology industry after hiring surged during the pandemic. According to employment firm Challenger, Gray & Christmas, US-based employers cut 102,943 jobs in January 2023 alone, a 136% increase from just 1 month prior, and a massive 440% increase from the same period last year. 41,829 of the most recent months of layoffs came from the tech sector. The second most being in the retail space, where 13,000 jobs were cut. For 2022, technology represented 25% of all US layoffs. Some numbers to keep in mind. Alphabet laid off 12,000 employees in January 2022. Amazon is working towards laying off 18,000 employees. Coinbase cut an additional 950 jobs in January, or 20% of its current workforce, after cutting 1,100 jobs in June of 2022. And Microsoft said it would cut 10,000 jobs, or 5% of its workforce. The tech downturn does seem to be an anomaly amid a still tight job market, which might suggest many laid-off workers will not have too much trouble finding work, a potential bright side for many who have lost their job. There are still many firms desperate for workers, according to Robert Frick, corporate economist at Navy Federal Credit Union. These workers are in high demand in many industries, from auto to the Department of Veteran Affairs. Snap's revenue growth hit a new low to end 2022, and executives said January has produced worse results. Snapchat's parent company reported fourth quarter revenue of $1.3 billion, flat with a year ago, the worst year-over-year revenue growth Snap has ever reported. The company said it lost $288.5 million, or 18 cents a share, compared with earnings of a penny a share last year. The Snapchat parent company, whose stock hit an all-time high of $83 per share in September 2021, has seen its share price plummet in recent months. The price temporarily dipped below $10 per share following the earnings announcement, though it's recovered slightly since. Snap disclosed Tuesday that its headcount is now 20% lower than at its peak. Like social media peers Meta and Twitter, Snap had a rough 2022 as a slowing economy led businesses to slash their digital ad budgets, and Apple's iOS privacy update limited targeting capabilities. Snap's stock plummeted 81% last year as the Nasdaq Composite had its worst year since 2008. The stock has recouped some of its losses, rising 29% in January, along with a broader rally in the tech sector. Snap announced in August it would lay off 20% of its workforce of over 6,000 employees. The company also shelved several projects during the year, including its photo-taking drone and Snap Originals premium shows. Three tech and consumer giants reported their earnings yesterday for the holiday quarter. All of them missed expectations to a degree. Apple sales fell 5% quarter over quarter, the largest decline seen since 2016. Apple missed sales on all major product lines, with the only segment seeing growth is the iPad. Gross margins came in better than expected though, but Apple reported EPS of $1.88 versus the $1.94 estimated, down 10.9% year over year. Amazon beat on revenue but missed on earnings and cloud segment growth. The company reported adjusted earnings of just 3 cents a share on a revenue of $149.2 billion. Analysts expected Amazon to report earnings of 17 cents a share on revenue of $145.7 billion. Cloud growth was only 20% and missed expectations. Amazon has shown its worst annual loss on record and least profitable holiday quarter since 2014. Alphabet missed on earnings and revenue as YouTube fell short. Earnings per share were $1.05 versus $1.18 expected, and revenue was $76.05 billion versus the $76.53 billion expected. YouTube missed heavily, bringing in only $7.96 billion versus $8.25 billion expected. The company said it would take a charge of between $1.9 billion and $2.3 billion, mostly in the first quarter of 2023, related to the layoffs of 12,000 employees it announced in January. It also expects to incur costs of about $500 million related to reduced office space in Q1. Thank you for watching today's episode of Weekend Windup. Don't forget to like this video, subscribe, hit the notification bell, and leave a comment below. And if you didn't watch Tuesday's career advice video, go check it out. I think you'll be caught just a bit off guard. As always, have an amazing weekend.